Hello, this is Steve Sanangelo of the SRS Rock Report, and today I'd like to do a market correction update as well as what's going on with the silver price. I also have a few other items and trends, important trends I'd like to discuss, but before I do, someone had mentioned that they couldn't see the pointer, so I tripled the size. I hope we can see it. I agree, it's much better now. You can see it more clearly. But let's discuss this chart. This is the Dow Jones and the silver chart. The Dow Jones is in the black line. We can see the movement up here, the correction in 2000, and then we had the movement up in 2003, and then the peak in 2007, and the crash. And now here, where we are, I call this the nosebleed section. Now the silver price looks different. It's in the blue area. And let me start with the lows. The silver price hit a low of $9 in 2008. And from that low to today, it's up 79%. The difference, the Dow Jones, it hit a low a little bit later. It was in the first quarter of 2009. It hit a low of 6,500. If we compare it to 24,200, it's still 272% up. This is the bubble. Now, the question I get all the time is, Steve, if you talk about the market's going to crash, well, the silver price is going to fall. And I've seen a few commenters saying they expect silver to be $10, $8, just like it was here. Now, that's true in a free and fair market, but we don't have free and fair markets anymore. And I'm going to discuss that towards the end of the video, and you'll see more information why I don't see the silver price falling much from here. But this red arrow shows a very interesting point in time, and this is when the Fed announced QE3 to start, September 12th. Now, at that point in time, the price of silver was 26. It shot up to 34 because investors thought when we'd see QE come in, another round of the quantitative easing, money printing, then it would push the price of the metals back up, as well as everything else. But it didn't last. Matter of fact, the price of silver went from 34 and now it's trading at 16. It's down 51% from the QE3 start. But the Dow Jones was about 14,000. It's up 82%. So again, the Dow Jones is in the bubble, not silver. Now, I want to discuss silver, but I first want to start with this chart that was at the end of January 31st. And the reason why I'm showing you the commercial short positions, because they give us an indicator. It's not a crystal ball. They don't tell us when it's going to peak. We don't know when things are going to peak, but we can get a good idea if we're close. And when the price of silver shoots to a high, as I explained, it was $18.20 in September, about 18th. The commercials had a very high net short positions, 84,700. The higher it goes, the more we see there's going to be a top. Now, when it sold off, then they liquidated their short positions. And on December 11th, when silver hit 1570, there was 18,600 commercial net short positions. It declined like 68,000. When the price of silver recovered and moved back up, the commercials added them. So we had 41,500 right about here. Now, this is the commercial COT report that corresponds to that. It 41,500, and that's the red bars right here. But as we could see, this is the low. When there's a low, that means the price is bottomed. Now, when I saw that, I thought the price of silver would continue to increase, because when the COT or the commercials hit a high, they have a very high number. And this was September. This was the 81,000 right here. That's when the price of silver peaked. Same thing happened right here. I thought we would see higher silver prices. But what happened? We had the market correction. And so the silver price sold off with the markets. And I knew initially it was going to do that. So the interesting thing, though, as the silver price fell, the commercials liquidated their short positions down to 30,600. So when the price of silver fell about $1, we lost about 11,000 net short positions in the commercials. And this is the corresponding chart for that. You can see how it fell. Now, what's interesting, we're having a totally different setup with the oil price. Now, this chart is a little bit older. It's January 19th when I did this, and I showed this shooting star. Normally, when you see a shooting star, it means a top in technical analysis, and that's just short-term trend. But another indicator is looking at what's going on again with the commercial short positions. As they increase, we get to a top. Now, when the price of oil in September 2000, at the end of September 2017, it was trading at about $45. There was only 350,000 commercial net short positions. As the price of oil increased, shot up to 64, it more than doubled to 732,000. And so at this point in time, I thought we would see a top, but guess what? It wasn't a top. That shooting star was right here. It fell and then it shot up to 66. Now, what that did, by the oil price moving up, it added another 30,000 short positions. And that's even about right here. So even though the price of oil has fallen about where it was before, it still has 30,000 more short positions. This was the end of the period for the COT report, was on February 6th. So the price of oil fell another $3 or $4. So when this COT report comes out, it's going to be, I believe we're going to see a liquidation. So here we are, 761,400. We're right here. We're a little bit less, but I think we're going to see an even a greater liquidation as the price of oil falls. However, I don't have a newer chart for this, but this one was at the beginning of January, and it's good to show this chart because in the beginning of January, there was 674,000. Now there's 761, not about 90,000 more. The interesting thing here, as I said before, this is the oil price. It fell from 147 in 2008 down to 30 and in the same year. I think it was 2009. It fell down to 30. Then it increased up to the 100 mark. But look how long it took for the commercials to continue to increase. It went 5 years. They did it this time around in about 2. It bottomed at 180,000 contracts when the oil price bottomed at 30. They had 180. Now it's not 674,000. It's way down here. It's 761,000. I believe we're getting ready to see a big decline in the oil price. And it'll probably happen, especially when the market continues to correct. So getting back, I just wanted to show you this chart. Now, the reason why I wanted to show you this, the COT structure, the commercials are still at their record high position. Now, if we compare it to the silver is closer to its low. So people who are saying, no, the silver price is going to fall, yes, it can fall. It can continue to fall. It can go down. It could go down another couple dollars maybe. But silver is more at a low. Oil is not. Oil is more towards at a top. Now, I think we're going to see serious trouble within the next 2-3 years with the U.S. shale oil industry. It could happen sooner. And the reason why I think we're in trouble, I'll show on the next chart. But this chart is had an article I wrote that shows U.S. oil production. This is a chart of U.S. oil production. It starts from 1900, peaks in 1970, falls, and then it shoots up again. Now, what's interesting about this chart, it doesn't happen with all oil fields, but a lot of them behave this way. They move up and they decline in the same symmetrical kind of way. This was conventional oil. It took 23 years for the United States to go from 5 million barrels of oil production per day, 1947, to 1970. It took about 23 years to double it. Well, it fell, and in 2008-9, it was 5 million barrels again. But we're now back at 10. We've actually surpassed the other high of the shale oil, but it did it in about 7-8 years. This is like the Dow Jones chart. This is like the Bitcoin chart. This is not sustainable. This is more sustainable for a longer period, even though you peak. This is not. We're not going to see 100 or 10 million barrels of oil for next 10, 20 years. What goes up comes down in the same fashion. Now, the reason why I believe that is the financial situation in the shale oil industry. Now, Hess isn't the largest, but they're a pretty good company producing shale oil and gas. And this is their free cash flow statement. You've got basically the three statements you get from the oil companies are their net income, their financial statement, their free cash flow, and their balance sheet, how much assets and debts. The most important one I look at is the free cash flow. I don't even look at really the net income. Reason why? Because Hess had they had a net income loss this year. And the reason for that was this huge impairment of $4.2 billion. Basically, they had to downgrade or write off their resources. That impacts their net income. But doing cash flow, they add it back in. So you get a more realistic number. Now, what this number here is what this is their cash from operations. When they did everything, Hess made $945 million operating cash in 2017. Now, to produce the oil and gas, it cost them $1.78 billion. So unfortunately, Hess lost $843 million producing shale oil and gas. Now, Continental and Whiting, they're not going to release their results until February 22nd. And I'm going to do an update once they do that. Now, the oil price did recover significantly in the third quarter, so we're going to see a little bit better financials. The problem is there's a lot of debt on these companies' balance sheets, and they're not going to be able to service that debt. And I'm going to do an update shortly about the energy companies because we're seeing it's a Ponzi scheme. They're getting offering new senior funding, $1 billion of senior notes to pay off old notes. This is a Ponzi scheme using new money to pay off old money. But this is the reason why we're going to have big trouble with the shale oil industry in the next few years. Now, this is interesting. I wanted to find out median price, what was going on with the U.S. median sales price. And I came across this article, and it's a funny article. I'll tell you why it's funny. The person who wrote this is trying to rationalize that what the price is now, and according to the Federal Reserve data, the U.S. median home sales price, December 2017, was $246,000. That's about right here. Now, this article is making the point that we're really not in a housing bubble. So it says, as home values continue to rise, some questioning whether we are approaching another housing bubble. And Zillow says national home values have surpassed the peak hit during the housing bubble and are at the highest value in more than a decade. And we could see that, 246, and back in 2006, they were about 220. So they're $26,000 more. Now, the person who wrote the article says, though that statement is correct, we must realize that catching prices of a decade ago does not mean that we're in bubble numbers. Here's a graph of the median prices. So this is what they're saying. Now, what they do, there's part two to this. They start off in 2000 and show a normal appreciation that it comes to about the same level when you take away the bust. So they say we could see that the prices rose during the early 2000s, fell during the crash, and have risen since 2013. However, let's assume there was no housing bubble or crash, and that the home prices appreciated at normal historic levels of 3.6% annually over the last 10 years. Here's a chart comparing actual price appreciation, tan bars, with what the prices would have been with normal appreciation, like there was no crash. So what they're saying is the housing price would be about what it is if we take out the crash. Now, this is delusional thinking, and I'll tell you why it's delusional thinking, or it's superficial. It's superficial analysis, and I see this everywhere, and especially with analysts who are professional analysts that should know better. Now, they're assuming a 3.6% normal home price appreciation because it's historic. Well, what does historic mean? Well, historic means it came from the past. And we were able to enjoy rising oil production in the 50s and 60s, even though U.S. oil production peaked in 2000 in 1970. We brought on imported oil. We had the petrodollar, and we made up the difference, and we went into debt doing that. The thing is, you have to have growing oil production to be able to have rising values in your home prices. Now, this here, the rising home price, we can see it better. This is the, you see the QE3 started right here in September 12th. This is it, inflation, asset inflation. This isn't appreciation. This is asset inflation. Either it's money printing, it's low interest rates, it's QE. This is not sustainable. And we have to remember, when the crash hit, the housing prices were 220,000. They fell to a low of 150. We're going to see much lower prices. So no, we're back in bubble terms. Now, can we continue higher? We can. I don't have a crystal ball, but the higher it goes, the bigger a bubble it is and the bigger it falls. Now, I've mentioned I've been seeing this leverage in the market. I knew we were going to have a correction. I think we're just beginning. Even though we could see a movement higher again, and they could try to push it higher. The amount of leverage, the margin, the indicators are way out of whack. So that means we have to have some kind of big correction. And I came across this article because I agree with this analyst. There's a few good ones out there. We are living in a reality distortion. Mark Spitznagel warns this is not over yet. Just a week before the biggest spike in the U.S. market volatility ever, something no one in the mainstream ever thought was possible, Universe's Mark Spitznagel warned a reckoning always follows. Something really big is coming. I had that feeling too, but you can cry wolf. And so what he says is, this is the chart of the S&P. Now the S&P is, you could superimpose it with the Dow Jones. They're almost the same thing. We had the movement up, we had the correction in 2007 and the correction, and here we are now. Well, look what he sees. The S&P is a risky thing to hold. It does not feel that way, but it is. And in bold, I expect in the coming years, we will take back a decade. Here's the decade, we're going to take it all back. Now, I agree with Mark, and I'll show you why. I wrote this article, which is the foundation for this video, and this is where we are. And matter of fact, when I did this chart, it was right before, it was in the morning, and then we had the huge rally, so it closed, the Dow Jones closed at 24,200. But here we could see it was at its low on Friday. Now, if we go by technical analysis only, and it normally works because you've got, this is bubbly indicators. This is not sustainable. Well, the first level is here, 18,000, which is, it's the support level. That's the first level we're going to hit. Now, could we move back higher? We could. I don't know I can't give you a crystal ball, but when the market really corrects where it should correct, this is the first level, 18. Now, what Mark is saying, this is the second level here, 13,000. This is where we should be. This is the 200-month moving average. It's half of the 26. That's the next level. And if you look at the S&P, or I'm sorry, the Dow Jones, it actually went down to the 200-month moving average. It went below it because it went to 6,500, which was here. It went way below it. But that's why I see this market going to 13 or possibly lower. Now, this is just going based upon normal PE ratios, normal markets, no bubble, no high inflationary asset prices. This is normal kind of business as usual. but we've got problems with energy. And if you've been watching and reading my work, energy is the most important. So the ultimate value, fair value for the Dow Jones is 3,000. It's at least it's 90% overvalued. Now, the Dow Jones was 3,000 back in 92. I would suggest most of this is inflation. Most of this is inflation. It's asset, it's debt. So it's not worth it. The value of the stocks are not worth this price. That's why we're going to get back down to the 90,000. And especially when the shale oil industry implodes and oil production falls, we could see oil production fall considerably, 30, 40, 50% in a short period of time. That will really hurt the US economy and the markets. Now, I want to get back to the silver price because silver is the underdog. I like gold, but silver is the underdog. It's the poor man's gold. And if you've seen the data I've shown of the COT structure, that we are seeing that the commercials are getting closer to their lows of their short positions. The cost of production for silver is about $15, $16. We're trading right now at 16. And so when we saw the stock market increase up to its high, the silver price increased. And then everything fell. This was, I'm not saying 100% fair market or unrigged market, but we had inflation moving into silver, we had inflation moving into the stock market, and then everything, oil price, gold, everything crashed. So yes, if the silver price with the QE3 program, maybe it declined but moved up, and let's say it was trading in the 35, 40, yes. Then I could see a massive correction, but it's not. It's way down here. We've had a big disconnect ever since the QE3 program. The Dow Jones went up and gold and silver went down. So to conclude, we could see lower silver prices. Again, I don't purchase silver or gold or own gold or silver, invest in gold and silver because I want to trade it. I'm not investing in gold and silver to make monthly interest gains like the Dow Jones. I think most retirement accounts are going to implode. I think you're not going to have, your Social Security is not going to be there. Pension plans are going to be gone. These are the reasons why you invest in gold and silver. Now, if you want to brag that you made a lot of money here, hey, that's fine, but you got to sell. You see, you have to sell here. Now, what happened during this huge crash? Several brokers, online brokers, they shut down. You couldn't get in there and sell. So what happens if there's a 3,000, 4,000 point correction? The issue is you should not be investing in silver for short term. It's like insurance, but I think it's insurance that's going to pay off because the energy is something that's going to be very problematic. That's not an if. It's not whether your house is going to catch on fire. The energy problem is going to happen, and it's going to happen probably much sooner than we realize. So that's the reason why we own gold and silver. As we can see, the bubble is here. It's not here. Can we see lower gold and silver prices? We could, but I don't think much. And I will tell you this, the gold price at 1,300 is higher in relation to its cost of production, which is about 1150, maybe 1,200. Silver price cost of production is about 15, 16. So I think silver is closer to its lows than gold could be. But again, even during a massive crash or correction in the stock market, we could see a little bit lower prices, but I think we're going to see a turnaround. We'll see a turnaround in gold and silver because this will be the fear. The fear and I mean, right here, look what happened right here. When the markets were selling off, the silver and gold price shot up. We had record gold ETF flows. This is what I see happening when the markets really, even though the markets fall in 2,000 points, some people are a little bit worried, but they're not going to get worried till it really starts to decline. When it really starts to decline, That's when believe we're going to see a big movement in gold and silver, as well as investors getting back into gold and silver. Well, thank you very much for watching this video. I will be coming out with a new video on the energy industry when they come out with their results. So if you would like to subscribe to the SRS Rock Report YouTube channel, I want to thank you very much. And I hope you all have a good night. Thank you.